2026 has arrived. And as we head into the new year, the theme of the previous one, at least from an investor's point of view, might be best summed up in one word.
I think the word that I would use is resilience.
That's Yuko Girard, VP and Portfolio Manager on the Multi-Asset Management team at Scotia Global Asset Management.
I think there was a lot of negative news in 2025, especially at the beginning. And despite that, the market and economy really held up.
Yuko is here this episode to help us break down some of the key themes in 2025 and what investors can take away from each of them as we head into 2026. From headlines versus reality to trade uncertainty to AI, she'll walk us through the last 12 months and give us some tips for the year ahead, so you can step into the new year as an investor with confidence.
I think the main takeaway is that discipline beats panic. We saw that really showing in 2025, and I think it will carry on to 2026.
I'm Armina Lagaya, and this is Perspectives. Yuko, welcome back to the show.
Thank you for having me.
Today, we're going to help investors better face 2026 by looking back at 2025. So in the intro, we heard your one word to sum up the theme of 2025, resilience. We'll get into the details in a moment, but is there an overarching theme of what lesson investors should take away from 2025?
Yeah, I think the lesson that you can take away in 2025 is really discipline beats panic. I think there was a lot of panic after the Liberation Day. There was a global stock sell-off. People were scrambling to get out of the market because there was already a negative sentiment building up, and they thought bear market is coming. So they didn't really question. They thought this is it, and they just start selling. And then what happened after that is in a week, they kind of reversed or paused that tariff, and the market started to rebound. That was one of the biggest daily rebound in history of almost like close to 10% in the U.S. And now disciplined investors just rode that market and get back to where they were. But, the investors that got out, they were scrambling to get back in. So, event-driven self is often very short-lived. The markets often rebound very quickly, and sometimes panic selling is just a tax on impatience. In general, if you hold the line, discipline usually wins.
So discipline beats panic. So those who stayed disciplined and did not panic or kept calm and carried on, if you will, those are the ones who really benefited at the end of the year.
Yeah.
So let's break down some of those themes. There's obviously a very eventful year. So let's look at one big factor that you've already mentioned, which is tariffs and U.S. relations. Why don't we look at that specifically? How did that affect investors in 2025?
Investors never like uncertainties. So that picked up volatility. The people weren't sure what was going to happen. And because 2024 was such a great year, people made so much money, they were just wondering, should I take the profit? Is this the time the market's going to go down? There was a lot of thoughts and confusion in the markets. And then because a lot of the stocks, especially in the US, like the Max 7 stock, the mega cap tech stocks, they did so well, it was highly valued. So it was priced to perfection. So if something negative happens in the economy or in anything, the price is going to come down. So people are very sensitive about these negative sentiment. And so what happened with all these uncertainty is that in the first 4 months until mid-April, the stock went down, especially in the U.S., especially in these mega cap names. They were down double digit. Tech sectors were doing worse than the other area of the market. Compared to some, Canada was pretty flat. And surprisingly, international was actually doing better because they didn't do that well the year before. And I think the valuation, it was cheaper. There was some opportunity, but it really started there. So the first 4 months of 2025, it was that negative sentiment, a lot of stock sell-off. But then I think after the pause and after the recovery, people start to think, how is the tariff going to actually get implemented? How is it actually going to affect the company? So there was a little bit of like people starting to asking questions instead of panicking and saying, the tariff is going to come, everything's going to fall apart. So during the summer, after the April, markets start to recover. And then by the summer and after the summer, people are getting a little more comfortable taking back risk. So it was a little bit more risk on sentiment. Also, interest rate start to come back in with the U.S. most likely going to cut rates, which is good news for the equity investors. So I think, it started down, it started to recover after that, and then started continuing to increase and go up. It's actually a very surprising year, even for us, how it unfolded. We didn't think the market will be that strong. But I think the AI themes is something that we can talk about a little bit more, but that really also continued to help the market in 2025.
So tariffs sort of sparked an initial panic, but then as the details and the reality set in, it sort of turned to be more surprising and more positive by the end.
Yeah, I think the one thing with tariff is that it takes time to see how it's going to affect the market, how it's going to affect the economy, the job market, inflation. It takes time. So you're not going to see that right away. You're going to start seeing the trend. And even like different industry, different companies, they may have time to deal with it and figure out a way and adapt before it really hits them. So actually, even though tariff and all those talks were negative to the market and the sentiment, there was some positive, like in Canada. There were interprovincial agreements happening. And also overall, the Canadian market did better than the U.S. market.
Mm-hmm. Is there a lesson in there about the headlines versus the reality?
Oh, yeah. I think the headline always tried to grab your attention. So it makes it scarier than it actually is. And that's what really happened in 2025 as well. If you look at the first half of the year, a lot of people are, predicting recession. But what really happened, and when you really look at it, at the data, it didn't get worse than that much. And like I said, it held up. So you don't want to really react on one headline or a few negative headlines and think that that is right. Do your homework, look into the information, and make your own decision. And if you can't, rely on the professionals that can make those decisions.
Mm-hmm. Well, obviously, hindsight is 20/20, but when you're in the thick of it, and you had said discipline beats panic, but when you're in the middle of it, how can everyday investors spot that difference between perhaps a short-term panic versus a deeper market correction?
So one thing is that you have to know that market corrects all the time. Going down around 10% happens every 1 to 2 years. So this is the market. You're taking risk, and that's why you're rewarded for it. So first, think about why you're investing, what you're trying to achieve. Put together a portfolio that you think in the long term will be able to achieve your goal. And then when you're looking at if the market starts to, decline, and you want to know if this is the beginning of the bear market or if it's a short term, like a panic sell, look at the fundamentals. Like we always look at the fundamentals, and fundamentals mean corporate earnings, corporate revenues, and also the economic indicator, like the GDP growth, inflation, the job market. One of the things since COVID that is keeping the market fairly up or stable is the consumers. U.S. consumers especially, they have been strong. They have been spending. And even though there's a lot of talk about tariff and AI all may affect the job market, people might lose a job, we do see the weakening, but it's not deteriorating yet. So you don't need to react right away. Maybe if you have new money, maybe you invest a little more defensively. If you're not sure, don't go into the most risky assets. If things are getting a little wobbly and, market are getting a little volatile, maybe you go into a little less risky or defensive area, but nobody can time the market. You shouldn't be pulling in and out of the market. That is the most expensive way, and it's the most hurtful way to really deteriorate your investment portfolio. So I would say stay disciplined, look where you are, look at the fundamentals, and make the right decisions. But one thing is, the more you trade in general, it really doesn't pan out to be the best way to manage the portfolio.
So take a breath, do your homework, and then make your decision. So looking forward to 2026, what is that lesson?
I think in 2026, one of the things that we find is 2024, definitely that Mag 7 really pulled the market up. There's 7 companies that in 2024 all did very well, and that's why they're called Mag 7 or Magnificent 7. But in 2025, after they dipped in the first few months, some recovered really well and some just did okay. Overall, they're still positive and they did okay, but there is now a difference between the real winner in the Mag 7 and the one that's kind of figuring out how to adopt the AI and do better. So I would say, Mag 7, the AI themes are continuing to deliver good performance. These Mag 7 stocks are going to continue to do well, but there will be difference between these 7 names. And so I'll be careful not to lump all that together, but kind of look at individually. So there's going to be more fragmented opportunities in 2026. The leadership is broadening. You're not going to go and just say, buy Mag 7 or buy US mega cap or buy NASDAQ and you're going to be good. I think there's going to be areas of opportunities in US and outside of US. And even in 2025, we saw actually US didn't do as well as Canadian or international market. Actually, there was more opportunities outside of the US. And people who just stuck to and thought just holding Mag 7 and the mega cap tech stocks is going to continue to give you that great return, that really didn't happen. So I think the lesson from 2025 into 2026 is that the opportunity is going to be more scattered. You have to really identify. In order to do that, you need to be diversified. So not one area, or not one sector, not one region are going to be the only place that's going to do well. So you want to be really diversified and exposed to different areas of the market. And also, I think identifying that opportunity and be nimble is going to be a key in 2026.
I wanted to go back and go a bit deeper on AI and Mag 7 and tech, because that very much was a big theme for 2025. How did AI factor in for investors in 2025?
So AI, it's interesting. Initially, it was really nice to have. People were excited. People didn't really know how to use it, but some people started to figure out how to use it. And it was still like a hype. I think by 2025, it became more reality. So maybe even in your workplace or even in my day-to-day life, AI is becoming integrated into our life now. It can really improve your efficiency. These are the kind of the themes, like the AI factors. It's not just about the Mag 7, that the chips and what's enabling the AI. It's now like how the AI is expanding to the other parts of the market, or other part of the industry. And you could see the AI being even spilled over to some old economy, like the utilities or the infrastructure. So I think the AI going forward is really about where it's going to expand. There's other areas like the AI value chain area, that semiconductor or the cloud infrastructure that is also benefiting of it. So it's expanding. You have to identify where that opportunity is and really kind of figure out, even within the companies, which one is adopting it well, as opposed to which one is just saying, oh, I use AI, but really you don't know exactly how they're using it. And it's not easy to do that just by looking at a balance sheet or looking at some of the ratios. You actually have to meet the management. You have to talk to them. You have to see how they're deploying their capital, where they're deploying it, how they're making their operation more efficient, or how they're increasing revenue. The only way really to do that is visiting the company and meeting the management. And that's something that probably passive invested funds will not be able to do. Active manager, we actually go on site and look at that. And that's where we can identify the opportunities. So I think AI is not a hype anymore. It is a reality. So people need to kind of see, okay, what does that do? And how is that going to affect the company and affect the market and affect their life and affect their profitability? It's a key theme that I think is going to continue in 2026.
Another key word, and we talked about this a lot, is whether it's tariffs, global events as well, is volatility. What is the main lessons that investors can take away from that in 25 heading into 2026?
I don't think volatility is bad. Like for us, we actually do like volatility in the market because that's where you actually do find opportunities. And like I said, there's investors who will panic and sell. And that's when us like professionals actually find some stocks are getting cheap and getting to the right price that we were looking for. So I think volatility is part of the market, and you have to understand why the volatility is coming, and you have to actually know how to take advantage of it.
So how should investors think about seeing that volatility, seeing opportunities, and perhaps rebalancing portfolios after a market swing? How should they approach that going into 2026?
Like I said, I think the leadership is broadening. The opportunities are more fragmented. So you need to diversify, first of all, but you also need to look at actively managing the portfolio. And whether you can do it on your own or you want the professionals to do it, but active management actually is going to be a key going into 2026 because it's not like one label that all the company that has a very similar theme or similar kind of industry is going to just do well. So going into 2026, I would say look into what you're holding. One thing that I also want to emphasize, and I have done it with few investors as well, index is not a very diversified portfolio. So whether it's Canada, whether it's US, Canada has always been concentrated in financials, materials, and energy. And we always say that there's a better way to manage a Canadian equity market than just investing into S&P TSX. Now that's also true in S&P 500. 7 stocks, that's not even 10% of the 500 stocks, are more than 1/3 of the S&P index. This is very concentrated. So if one of those don't do well, which some of them didn't do well this year, you think you're invested in a passive S&P 500 portfolio, you think you're well diversified with 500 companies, you're going to actually feel that volatility much more than maybe active managed portfolio. So that's one thing that going into 2026, be careful. When you're investing into something, just make sure what kind of exposure you're actually having. Just don't think you go into a certain fund so you think everything is taken care and you don't have to look into it. Do your homework. Make sure you know what you're holding.
So diversification is increasingly important, and take a closer look, because in terms of tech, compared to the past, it's a much higher concentration in terms of weighting.
Yeah, exactly. Valuation is also a key, right? You have to know how much you're paying for the stocks. And, if you've been holding it for a while, maybe you bought it at the right price, but now it's expensive. Maybe there's an area that you can take a profit from that tech name and put it into something that's reasonably priced. And probably those are the area that will do better than the names that already did very well in the last 2 years.
What is one surprising trend investors should watch for in 2026?
I think surprising trend of what we've already seen is that AI boom is spilling over to other areas of the market. So like I said, it's not just about technology anymore. So you have to really think like, where is it spilling over and who is benefiting from the spillover? The second thing is really that concentration. Like I said, there's a lot of areas that it's concentrated. Passive index is concentrated. There's a lot of funds that people like to be concentrated in one theme, and you have to be very careful of those concentrations. So the hidden concentration, especially in the passive type of structure or the funds, is something that could be surprising in a negative way in 2026.
So before we wrap up, what do you think is the main takeaway from 2025? And then one key theme for 2026?
I think the main takeaway is that discipline beats panic. It was very interesting how the market turned around so quickly, and how investors were so panicking and the market moving so much. And at the end of the day, when you look back, it's almost like that 1 week, it really didn't affect the entire year. It was just that 1 week, but a lot of people got hurt in that 1 week. So I think, discipline is really a key. And I think, I don't want to repeat, but diversification, it is an offense and a defense for investing. It sounds boring, but it's the smartest way to invest. And sometimes some areas you see your portfolio and says, oh, this part is not really doing well, so I'm just going to sell and pile it into the ones that are doing well. That's the most dangerous way to invest. Like, you have to know that diversification means that there's some parts that's going to be working, but some parts are not working, but they offset each other. And what happens with that is that you're actually reducing the risk in your portfolio. So when you look at the risk-adjusted return, you're actually achieving a much better return by doing that than trying to time the market or trying to bet on certain areas. So I think it's nothing new. But we saw that really showing in 2025, and I think it will carry on to 2026.
Thank you so much for coming on the show and giving us some perspective on the year that was and the year ahead.
Thank you for having me.
I've been speaking with Yuko Girard, VP and Portfolio Manager on the Multi-Asset Management team at Scotia Global Asset Management. The Perspectives podcast is made by me, Armina Lagaya, and our producer, Andrew Norton. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time. This podcast has been prepared by the Bank of Nova Scotia and is provided for information purposes only. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments, including ETFs. Please read the prospectus before investing. The indicated rates of return are the historical annual compound total returns, including changes in unit values, and reinvestment of all distributions does not take into account sales, redemption or option changes, or income taxes payable by any security holder that would have reduced returns. Mutual funds and ETFs are not guaranteed. Their values change frequently, and past performance may not be repeated. Views expressed regarding a particular investment economy, industry, or market sector should not be considered an indication of trading intent of any of the mutual funds managed by 1832 Asset Management LP. These views are not to be relied upon as investment advice, nor should they be considered a recommendation to buy or sell. These views are subject to change at any time based upon markets and other conditions, and we disclaim any responsibility to update such views. To the extent this audio contains information or data obtained from third-party sources, it is believed to be accurate and reliable as of the date of publication, but the Bank of Nova Scotia does not guarantee its accuracy or reliability. Nothing in this podcast is or should be relied upon as a promise or representation as to the future. The information provided is not intended to be investment advice. Investors should consult their own professional advisor for specific investment and/or tax advice tailored to their needs when planning to implement an investment strategy to ensure that individual circumstances are considered properly and action is taken based on the latest available information. Scotiabank includes the Bank of Nova Scotia and its subsidiaries and affiliates, including 1832 Asset Management LP and Scotia Securities Inc. Scotia Global Asset Management is a business name used by 1832 Asset Management LP, a limited partnership, the general partner of which is wholly owned by Scotiabank. Registered trademarks of the Bank of Nova Scotia used under license. Copyright 2026, the Bank of Nova Scotia. All rights reserved.